What's going on, fam? Economic Prepper here. As millions of Americans are living paycheck to paycheck and are finding it more and more difficult to get by as a recession of 2022 looms, whether you're collecting Social Security, SSI, SSDI, railroad retirement benefits, a 401k distribution, a pension, or any other form of passive income source, inflation has absolutely taken a severe toll on everyone, especially the middle class and lower income classes. And the Great Reset is taking a huge toll on everyone, especially the middle class and the lower income families. But what is the Great Reset, you might ask? So the Great Reset, this initiative is an economic recovery plan drawn up by your favorite folks at the World Economic Forum, also known as the WEF. Now, even banks are feeling the pinch, and banks like Wells Fargo are closing accounts that they deem to be high risk in order to maximize their profit margins and to attempt to mitigate future losses that would otherwise impact their balance sheets and ultimately affect their stock market performance for 2022, as well as the stock market performance for 2023. Now, you also have Argentina. So Argentina is set to hike interest rates by 75 points or 75% as inflation nears 100%. So here we are here in America. We're thinking that inflation is awful, which it is, at 8.7% based on our CPI numbers that have come out recently. But realistically, because the CPI numbers, they ignore energy and food, our core inflation, our actual real inflation that you and I feel each and every single day, it's much higher, easily in the double digits. But Argentina, on the other hand, their inflation is near 100%, which is just crazy to even think about. So Argentina's central bank, it raised its benchmark interest rate Thursday in a bid to attempt to prop up its currency and curb inflation, which is nearing 100%. Now, Argentina's central bank, it raised its benchmark interest rate on Thursday in a bid to attempt to curb this inflation situation. Now, central banks across Latin America have raised rates this year to combat high inflation, but prices, they continue to stay red hot at as high levels of all cash workers, and businesses make monetary policy less effective than in developed economies. Well, what do you think? If they're paid cash, do you think everyone's reporting their income? I think not. Now, Argentina's central bank made incremental rate increases earlier in the year, but over the past 3 months has ramped up its hikes with a combined 23 percentage point increase since July. Now, while the United States is not quite as bad off as Argentina's economy, the United States economy is still facing similar challenges, which could ultimately lead to one of the largest Social Security increases as we head into 2023. Now, Social Security recipients, they could be set to receive a Social Security raise of $200 or more going into 2023. Now, of course, nothing is guaranteed, but, it is a possibility. For more news and discussions on economic preparation, the U.S. economy, the stock market, economic preparedness, passive income, make sure to subscribe to the channel and also tap that notification bell. I really appreciate that, you guys. I love sharing the news and updates with you. But I got a question for you. Are you feeling the pain as you pay for groceries each and every single week? Are you spending more and more of your income on gas, utilities like electric bills and your phone bill? How about your cell phone bill? Is this going up any higher? Verizon recently indicated that a tremendous number of delinquencies are starting to set in as people are falling more and more behind on their abilities to be able to pay their cell phone bills. So the question is, are you finding it harder to save and invest on a low income? Well, if so, you are not alone. Millions of workers and employees are either walking off the job or they're participating in what they're calling quiet quitting, maybe even union strikes. I know you guys have heard in my previous videos, as well as other channels such as Kevin, about this massive railroad strike that is, let's just say, it's on hold at the moment. But quiet quitting is becoming more and more popular among U.S. workers due in part to the pre-pandemic burnout. Now, quiet quitting refers to basically employees not trying to go above and beyond in the workplace, and they're only doing exactly what their job description requires. So they're not trying to get extra credit, basically. Fed Chair Jerome Powell, he continues to warn stock market investors, housing market buyers and sellers, and the American people that more pain is coming. Now, stocks fell sharply on Tuesday after a very key August inflation report came in hotter than expected, ultimately hurting investor optimism for cooling prices and a far less aggressive Federal Reserve. Now, the August Consumer Price Index report, it also showed a higher than expected reading for inflation. Headline inflation rose 0.1% month over month, even with falling gas prices. But check this out. The core inflation rose 0.6 month over month. Now, on a year over year basis, inflation was 8.3%. Economists surveyed by the Dow Jones have been expecting a decline of 0.1% for overall inflation, with a rise of 0.3% for core inflation. So this report is one of the last reports that the Fed will see ahead of their September 20th through 21st meeting. Now, this is a very, very important date to keep in mind. And this is where the central bank is expected to deliver its third consecutive 0.75 percentage point interest rate hike in order to tamp down inflation. So, needless to say, things are actually getting worse as we predicted. Now, the unexpectedly high August report, it could lead to the Fed and their ultimately continuing to increase their aggressive rate hikes longer than some investors had anticipated. But we knew that this would happen. The housing market has not crashed yet. The stock market has crashed, but I think it has further to fall. And until we really see the housing market crash and there's like blood in the streets, I really don't think that the Fed is going to be letting off the gas anytime soon. Now, it gets even more concerning when we consider what Michael Burry had to say about this whole housing market situation, the stock market, and the economy in general. So Michael Burry, he became a household name after the 2015 film. I don't know if you guys have seen it. It's called The Big Short, which ultimately depicted his bet on the subprime mortgage meltdown that sparked the 2008 financial crisis. Remember all the subprime loans and all the interest-only loans, and just about anybody with a pulse could have gotten a mortgage back then? Yeah, that time. So anyway, in the book called The Big Short, Inside the Doomsday Machine from Michael Lewis, it's said that Michael Burry, decided to bet on the implosion of the subprime market after he noticed that a lot of people couldn't actually afford to pay their mortgages. But lenders were finding new creative financial instruments to justify handing them new money. Now, official data at Goldman Sachs shows that the most vulnerable consumers are no longer able to meet their payment deadlines. And this is very, very concerning, especially from a big company, big financial institution like Goldman Sachs. So Goldman's rate or loss rate on their credit card loans hit 2.93% in the second quarter. Now, this is the worst among big U.S. credit card issuers and well above subprime lenders. So this is crazy because these are not even subprime lenders, and Goldman Sachs is reporting these types of numbers. So chatter on the street is that the American, or I should say, Amazon, may have actually played a role in FedEx's stock price and business forecasts before peak holiday shipping season. Now, JP Morgan's Jake Atherton, he wrote in a note to clients that it makes sense to see Amazon to trade off with this, but there's such a competitive element that's going on here too. Now, coincidentally, Amazon's seller conference has been going on for the last 2 days, which focus very heavily on new features for Buy with Prime as it tries to focus on breaking down Shopify's moat. Now, if you're not all that familiar with Shopify is what online investors, entrepreneurs, it's a platform that many business owners use to create an e-commerce store where they can sell products online and generate all sorts of income and make money from home. And it's a big competitor to Amazon. So Amazon also launched free shipping software for sellers and discounted shipping rates. And ultimately, Amazon has piled money into its logistics capability over the last few years to the point that it has excess capacity for its own needs and it's hungry for more share, which is actually being targeted through their Amazon FBA, also known as Fulfillment by Amazon, and it could be weighing on FedEx. Now, whether or not you want to buy Amazon on the weakness now, because Amazon's stock price is a little bit down, that's your choice. This is not financial advice, but I think Amazon's a good company. I think it's got a very positive future in spite of what's going on in the short term. Now, FedEx, they served up a brutal earnings pre-announcement after the close of trading on Thursday, which sent stock shares crashing. Now, the logistics giant, the ticker page was the most visited on the Yahoo Finance platform in the wake of the warning, underscoring the severity of this particular disappointment. Now, you got rival UPS shares, which also fell around 7% in sympathy as investors read through the company may issue a lackluster quarter or pre-announcement in October. Now, you got FedEx CEO basically saying that global volumes declined as macroeconomic trends significantly worsened later in the quarter, both internationally and here in the United States. And we swiftly addressed these headwinds, but given the speed and the magnitude at which conditions have shifted, first quarter results were below expectations. Now, this is from the FedEx CEO. Now, while this performance is disappointing, they're aggressively accelerating their cost reductions, aka layoffs, massive layoffs to the workforce. Employees, 1099s are likely to be affected. But this is what I'm interpreting that this is meaning. Whenever you hear cost-cutting efforts from, any type of business, corporation, stock, any company on the stock market, S&P 500, NASDAQ, Dow Jones, doesn't matter. Cost-cutting means expenses, and one of a company's largest expenses is generally payroll and employee benefits. So this is probably what this means. Now, so beyond that, they're looking at reducing their variable costs. They're looking to adjust and implement structural cost reduction initiatives. So, everything to help heal their balance sheet in a nutshell. Now, these efforts, they're aligned with the strategy that they outlined in June, and they're going to remain confident in achieving their fiscal 2025 financial targets. So that remains to be seen. We'll definitely keep you guys posted on that. But with FedEx offering a very dismal outlook for the future, this is a big problem for everyone. If you have a job, if you live with someone who is working, their job could potentially be affected, because if FedEx is anticipating that the future demand for their services, which is delivering products, is down, that means people are buying a whole lot less. And if people are buying a whole lot less, that means businesses and companies are taking in a lot less revenue, and their profit margins will likely be declining. Their revenues will likely be declining. And if a business is losing money, a business is then going to look to cut costs. They're not going to be expanding, and jobs will likely be lost. Now, economists are saying that the U.S. Federal Reserve could be forced to pivot away from its path of aggressive interest rate hikes in 3 stages. Now, markets, they expect the central bank to enact a third consecutive 75 basis point rate hike at its monetary policy meeting, which is going to happen later on this month. The meeting is scheduled for September the 20th through the 21st. We would expect to hear from the Fed on their plans on moving forward shortly after that. Now, the fastest pace of monetary tightening is taking place since policymakers began using the benchmark Fed funds rate as their principal policy tool in early 1990s. Now, various Fed officials have reiterated the Federal Open Market Committee's commitment in recent weeks to rein in inflation, but the acceleration of interest rate hikes to soothe the markets was disconnected from the economic reality faced by many. Now, the period of accelerating the rate hikes that we've seen so far has impacted the global economy, and the real economy because it squeezed the borrowing costs. And this is affecting real people, real consumers. Now, despite the broad market expectation for further 75 basis point hikes, Prin, a global economist and outspoken advocate for the economic reform, said that the Fed would likely pivot away from its hawkish trajectory in 3 stages as the disconnect between wealthy investors and institutions and the real economy widens. And this is just more of the rich getting richer, the poor getting poorer, and widening of the wealth gap, unfortunately. Whereas for the street in general, historically, money still remains cheap and leverage remains high in the system, and the Fed's book still remains just a touch under $9 trillion, which is double what it was going into the pandemic and since the financial crisis of 2008. So with that being said, as the Fed continues to move forward with quantitative tightening, we can expect that we will feel a lot more pain moving forward, as they're about $4.5 trillion larger on the Fed's balance sheet than they would like to be ultimately. But inflation worldwide has been driven skyward by the supply chain bottlenecks in the aftermath of the C-19 pandemic. You got the lingering supply bottlenecks and blockages in China due to recurring lockdowns. You've got Russia's invasion of the Ukraine, which has caused food and energy prices to surge, not to mention food shortages. And millions of Americans are attempting to prepare in the wake of this, but also moving forward as more potential food shortages could be likely, especially as we're also dealing with fertilizer shortages and reduced farmer crop yields. Now, at the speech from the Fed Chair Jerome Powell, he was out in Jackson Hole at the Economic Symposium back in August, or I should say late August. Fed Chairman Jerome Powell responded to market concern about impending recessions caused by tightening of the monetary conditions, and by asserting that some pain for the economy would be necessary in order to fight against inflation. Now, the group's latest COLA estimate is well below earlier estimates this year, and the estimates that projected a Social Security increase as high as 10.5% in 2023. However, an increase of 8.7% would be the largest move in more than 4 decades. Now, a COLA for Social Security of 8.7% is extremely rare, and it could be the highest ever received by most Social Security beneficiaries alive. The Senior Citizens League, Social Security, and Medicare policy analysts indicated that there were only 3 other times since the start of automatic COLA adjustments that it was higher, and that was 1979 and 1981. Now, the Senior Citizens League and other senior advocacy groups have often criticized the formula for calculating the Social Security COLA because it doesn't quite account for increases in the Medicare Part B premiums, which is 14.5% higher this year than compared to 2021. Now, this often leads to Social Security checks falling short of the actual inflation rate for seniors. For more news and discussions on the economic preparation, U.S. economy, the stock market, economic preparedness, passive income, make sure to subscribe to the channel. Also, make sure your notification bell's turned on. You guys be safe out there. We're going to make it through this. Be safe.